We got some massive news for Microsoft and Nvidia stock investors as the companies plan to invest in Anthropic under a new tie-up that includes a $30 billion commitment by the cloud maker to use Microsoft's cloud services. Now, this deal is yet another one in this series of circular financing where NVIDIA and others make an investment in the company that's also purchasing from NVIDIA. So it raises some risks, which I'll talk about in this video. The implications of these deals are interesting. So NVIDIA will commit up to $10 billion to Anthropic and Microsoft up to $5 billion, the company said on Tuesday, without sharing too many details. So in sum, NVIDIA and Microsoft will commit $15 billion in equity investment in Anthropic, and in return, Anthropic will commit to purchasing $30 billion of services from Microsoft's cloud services segment, which, by the way, Microsoft's cloud services segment purchases the GPUs that go into the segment from NVIDIA. Not entirely, but most of Microsoft's cloud services segment is run on the NVIDIA GPUs that go into that that data center optimized for artificial intelligence. So you can see why investors are concerned about the circular nature of these deals where they're making equity investments in return for revenue. And what I will say about that is it's a lower quality source of revenue. There are levels of revenue quality. Okay. The highest level of revenue quality doesn't include these kinds of commitments. The highest level of revenue quality is in situations where a company makes a sale to another company or to another individual, whereby that individual wants or needs that company's products or services and pays a price to purchase those products and services without anything else being embedded in that agreement. And then from that point on, it gets lower and lower and lower. Let's say you make a sale, but in that sale, you also give up a 3-year return eligibility. All right, that's a lower level quality of revenue because if you're offering a 3-year return window, there's a higher likelihood that your product will be returned and you'll have to provide a refund. Okay, so there's different levels of a quality of a sale that investors evaluate, and these are among the lowest levels of those kinds of sales when you're requiring an equity investment so that the company can purchase your product. One of the things this highlights is the company that's purchasing your product doesn't have sufficient business to purchase your products, right? Anthropic, without this arrangement, may not have committed to this level of commitment, $30 billion from Microsoft Cloud Services, because Anthropic is losing money on the bottom line and they're not generating enough revenue to support this level of investment. But if they are given attractive terms, they will make that investment. Anthropic will make that investment if they're given attractive terms. And NVIDIA and Microsoft gave them attractive terms and they took them up on the offer. And you might ask, why did NVIDIA and Microsoft give Anthropic these attractive terms where they committed to invest $15 billion in exchange for a deal to have Anthropic purchase $30 billion in cloud services? One of the reasons why Microsoft and NVIDIA were probably interested in this deal is to divest away from OpenAI and ChatGPT. Microsoft and NVIDIA are highly exposed to the success of ChatGPT and OpenAI. And if that company falters and Anthropic were to leapfrog ChatGPT, that would worsen the performance for Microsoft and NVIDIA. So they wanted to diversify a little bit away from OpenAI. They have too much exposure to OpenAI. That's one reason why they would be interested in making this deal. Another reason and another point to highlight between these circular investments is, yes, it's true that these are lower quality revenue sources. That's true. But it's also true that the companies making the commitments, making the investments, the equity investments. So in this case, we're talking NVIDIA and Microsoft. If they're investing 10 billion and 5 billion respectively, that means they see something in Anthropic's business at this current valuation that makes it an attractive investment. And so that's also a highlight of what they see with Anthropic in terms of valuation and the attractive valuation at current market prices. It also shows the future prospects of this industry and how attractive they believe this industry's future prospects are, in that they're committing more capital, more equity investment to this industry. So there's a few things to highlight from these types of circular investments. On the one hand, it's absolutely lower quality revenue sources. Absolutely, that's no argument there. But on the other hand, there's also some other things that it mentions, that it highlights about the industry when these kinds of deals are being announced at such large scale between relatively few companies. And lastly, another thing this highlights is a decreasing level of competition. A decreasing level of competition, which is very good for investors. Remember in my book, The Six-Step Framework, How to Make Money Buying and Selling Stocks, I talk about the level of competition as one of the six major steps when I'm evaluating any investment. And when companies are working together like this, it lowers the level of competition. And so it becomes less of a winner take all type of situation where it's either going to be OpenAI and ChatGPT that takes the whole market, or Anthropic with Claude that takes the whole market. It makes it more likely that there are multiple winners, and it makes it more likely that the industry overall is a more lucrative industry with profit margins sustainable to persist longer term. Whereas if they were competing with each other more fiercely, it would bring down industry-wide profitability and be worse for investors. So this is a sign of lower competition, which I view as a big positive, probably even more so than I view the lower quality revenue. The lower quality revenue is certainly a negative, but the signs of decreasing competition for me as an investor in the industry, I see that as more of a positive that offsets the impact of lower quality revenue. Now, I've calculated an intrinsic value for Microsoft at $490. The current market price is $493. So I see Microsoft's business as fairly valued. But Microsoft, I've said repeatedly, is a Hall of Fame business, and a Hall of Fame business trading at a fair value, I think, is an excellent stock to buy for long-term investors. So I have Microsoft stock rated as a buy. NVIDIA, meanwhile, I calculated an intrinsic value per share of $204. The current market price is $184. So applying a margin of safety, I can say that NVIDIA stock is slightly undervalued, utilizing my discounted cash flow valuation model. And so I have NVIDIA stock also rated as a buy. By the way, these spreadsheets you're looking at here are my proprietary DCF calculations. These are available for all my channel members at the investor tier or above, and I have hundreds of discounted cash flow valuations calculated on the spreadsheet. You can just go to whichever company you're interested in looking at, for instance, ASML, and you go to the intrinsic value per share, and the whole calculation is available here. But also, along with that spreadsheet, at the investor tier, you get access to my spreadsheet that holds all my buy, hold, or sell recommendations. You can see here, NVIDIA I have rated as one of the top 5 stocks to buy right now. And you can see my buy, hold, or sell ratings on hundreds of companies as well. You get all that with an investor tier membership to my channel.